Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with BD Dweik. BD is a successful real estate investor with over 25 years of commercial real estate investing experience. He has a commercial real estate investment certificate. He earned a commercial real estate investment certificate in 2019, focusing on value add investment through syndications and multifamily, retail, and storage, with ventures exceeding $400 million in assets under advisement. He is a father of two and enjoys cooking, driving exotic cars along beautiful coastlines in California, where he resides. He holds a Bachelor of Science in Electrical and Computer Engineering, an MBA with a magna cum laude. When BD is not working, he likes to donate his time to teaching youth, hoping to create a new generation with financial savvy. BD, I sincerely appreciate you joining me here today. I'm really looking forward to talking about all that you have to offer us today. How are you doing today?
Awesome. Thank you, Jonathan. I appreciate the opportunity as well. We connected through a different channel, and I'm really looking forward actually for our chat today.
BD, I know a little bit about your story. You are an inspiration with how you spend your time and the choices that you've made in your life. Why don't we get started by you telling us about a little bit about your background and what you do in real estate today?
Sure. I graduated college, with a degree in electrical and computer engineering. Straight off the bat, my intent was always to go figure out how things are made or how things are built. And right from there, I've got my first job at IBM as a design engineer. And as I got to relocate to Vermont, my manager was like, "Hey, you should really buy a house and rent out rooms because the demand on rent is really high." I was 21 years old at the time. I didn't have an idea exactly what I was doing, but I really became an accidental landlord early on, and that really opened up my eyes on real estate early on in my life. I stayed as a design engineer and kind of got promoted into a design manager, and then worked at various different startups in tech. But I always kept investing in real estate. Always owned properties, sold, bought again. Relocated to the Bay Area, California in 2006, and right after that started having kids. It was mainly a drive for me to continue my career progress in tech. And honestly, I was quite fortunate because in 2009, 2010, I realized the market has really corrected and it was a great time to buy more real estate. So I really doubled down and almost went broke as far as how much I bought in real estate. But it all has actually paid back multiple times. Um, I continued pretty much, my career in tech, three startups, three publicly traded companies. And eventually in 2019, I said, you know what, enough is enough. I really want to kind of go focus on my teenage kids. I want to travel less. I want to, manage my real estate investments. I want to get a lot more savvy by understanding and scaling up in commercial real estate. And that really started the second phase of the journey for me.
BD, I'm going to pause for 1 second. I had a guest join me here in my studio, so just give me 1 second. I'm sorry. So, sorry about that. For those not watching, I had my 3-year-old on my lap for the last minute or two, and she has taken an interest to my podcast interviews, and so that is part of the challenge of having a home office when when your 3-year-old is here. So, in BD, I want to get back to your story. I think you have a really interesting story. In your years as a tech worker previous to 2019, were you owning your own real estate, or were you a passive investor in other deals, or what did your investing look like at that point?
Yeah, so I would say I started transitioning from owning my own real estate and renting it into doing more passive investing around the late teens. And that was kind of me trying to tap my toe into the passive investing world. whether it was through lending or whether it was through trying out syndications, as an LP investor. But again, I didn't know a whole lot about what I was doing. I had to kind of take a leap of faith and invest a smaller amount of money just to really get the hang of it and try to understand how to really scale up from there.
In 2019, you got out of the tech world and went to real estate full time. Um, I would like to dive into that a little bit more because it's a subject that I'm really passionate about. Is using real estate to live the life that you want. I personally have seen the just amazing things that real estate can do to my life, and I know it can do it to other people as well. But so many people just choose to kind of stay in the rat race, or they get involved in real estate, but then they just create a full time job or more than a full time job for themselves within real estate. And you chose another path. So take me to 2019 and kind of what's the inflection point in 2019 that caused you to alter the direction of your journey?
Absolutely. I'll tell you, Jonathan, there was definitely the why factor, right? And you look back, I mean, tech has been great for me. I've had, a good career, got promoted, continue to have a good salary, nice stock options. So it kind of presented for me with a nice life for me and my family. But when I went look back and I started looking at my wealth, I realized a lot of my wealth has been because of my real estate investing. Everything that I've contributed in my 401k was definitely not even tracking to fraction of my wealth compared to what I've done. And so it really made me rethink in terms of what am I doing? Where am I spending my time? The second key reason was really health. I hit a health bump in 2019, and it really made me reevaluate my life in the sense is like, what's really the most important thing here in my life? Number one is my health. Number two, I want to be around for my children. Tech is, as you know, is a very consuming job. You have to travel a lot, especially as your responsibility grow. It just becomes to really eat into your time, into your family time. um, so I really kind of wanted to gain back that time. I felt like the best age for my kids growing up, which is really like, from 3, 4, all the way to 11, 12, I kind of missed because I was always on a plane, always traveling, heavily working. It really made me successful in what I was doing in tech, but definitely took away other things on the expense of other things. So it was really the health, being around with the family, made me realize I was like, hey, if majority of my wealth has been built from real estate, and I do have the intent to continue that and double down actually on real estate, then why, what's the value of continuing doing the same thing and expecting to have different results? So I really decided it's like, okay, now it's really time to double down or even triple down on real estate and scale just through commercial real estate. I realized that commercial real estate and passive investing uh, had produced a lot better return over a short period of time than probably owning a property and renting it. Yeah, owning a property at the right time, buying in short sale in 2009, 2010 was just not something that's going to continue to repeat itself. Versus finding the right deals in commercial real estate and being able to analyze them and kind of build a business plan around them and say, okay, what's the level of projection I can get, return on my capital, and so forth. It was a change of dynamics. So really opened up my eyes. I said, you know what? I really need to dive down, learn more about this commercial real estate, and really kind of rebuild my time. Financially, I was at a point in my life where I could get by, meaning I have enough income coming in to just live a very simple life. I'm not talking driving exotic cars and living in fancy homes. I've always been very moderate when it comes to my spending. I didn't have to upgrade to the $3 million house in California, even if it was affordable. I've always kept good about uh, you know uh, taking my RSUs, converting it into real estate, investing in notes, creating kind of passive flow of income. So it was really the time when I was like, okay, now it's time to scale. And that's really when I started digging into trying to understand how can I get my knowledge deeper into commercial real estate so I can invest larger and larger sums of capital, and be able to do it in a confident way, be able to do it a lot more. Initially, I thought maybe I'll become a GP, a general partner in a deal. But the more I looked into it, and I've done a couple of active deals, especially around the single tenant, it made me realize maybe going full time and becoming an active GP is just another job, and that's probably not the path where I want to go. I definitely want to invest in commercial real estate, but I definitely enjoyed the aspect of becoming more passive.
So much there, BD. I am thankful that you came out of that health scare in 2019. You know, better for it on the other side. I'm sorry that you had to go through that. And I would, when I see my family and friends kind of going through what you talked about, kind of, paying the bills and maybe even doing well, but missing those key moments with young kids and just sort of missing out on life. That really makes me sad, and I hope that listeners and friends and family, colleagues of mine, don't have to have a health scare or don't have to have that, that sad moment where they realize, wow, I've missed so much. Wow, I've sacrificed my health, or I've sacrificed so many things. And commercial real estate can be the tool to help people avoid those moments and to live a great life right now without having to, hopefully, without having to have that health scare or without having to have those moments of missing the special moments with family. BD, so you talked about maybe not wanting to go the GP route. Can you tell me what does your portfolio look like today? What do you spend your time doing in real estate?
Sure. So as I kind of widen my horizon in commercial real estate, initially you have a lot of shiny object syndrome. So you want to kind of get into anything and very quickly, brought it back to a focus. And after I learned how to evaluate various different asset classes, and what do I, how do I actually see a good deal from not so great of a deal? A lot of my friends, they were asking me, hey, can you show us what are the type of deals that you're investing so we can shadow what you're doing? And we did that for about a year and a half, where I would evaluate various different syndicators, look at the different deal flow from multifamily to storage to commercial retail, um, pretty much across all the asset classes, and pick the ones where I wanted to actually go in and invest in passively. And then a lot of my closer friends, they say, hey, we're going to shadow what you're doing. Up until 2022, when one of the GPs suggested that we actually go structure ourselves into an entity and start formally investing, as a group. So I went back, I spoke to the lawyers, I figured out exactly what's the right way of structuring it. And we ended up effectively, there was really two paths. One is what we call SPV, which is special purpose vehicle. And typically, when you're investing in a lot of startups and seed capital, people tend to go that way. But in order to have a scalable model to continue to invest across many, many deals, it was really about structuring a fund, or effectively a fund of fund. And it really started with just few of us into the fund. We bring in the deals, we analyze the deals, and when I'm ready to invest my own capital, I open it up to the rest of uh, the investors within the fund. And then we negotiate terms, and we actually subscribe in those type of deals. Seems like you had a question, so I'm going to pause here, give you a chance to dive into that.
Yeah, so you talked about first considering the SPV, a special purpose vehicle or single purpose vehicle, and you decided to go fund of funds. Can you, I don't, you're not an attorney, but can you talk about maybe your thought process or your deciding factors and the differences between an SPV versus a fund of funds?
Sure. So when I went through uh, let's just call it the diligence to try to figure out what's really the best path for what we're doing, in a special purpose vehicle, you are creating an LLC for every investment. So let's just say a deal comes in, we want to invest in it. We end up creating an LLC, and everybody is partners in that LLC, and we structure it per deal. We have to have a bank account for that one LLC. If another deal comes in, we have to do another structure with a separate bank account, with a separate tax filing. So every time there's a deal that we want to invest in, let's say in 2022 we invested in 5 deals in 6 months. We would have had actually 5 different LLCs with 5 different bank accounts and 5 different tax filings. So being able to scale with an SPV was definitely a problem. And that's kind of when we went to the other route. We're like, okay, what's a nice scalable way? We only do the structuring once. We only do file the taxes once. We only have a single bank account, but we want to have the flexibility to determine which one of the investors want to subscribe to which specific deal at different amounts. Initially, when everybody was shadowing, everybody was kind of investing the same amount as I was, and I had a tracker Excel sheet for how much I've invested and what's the return. But as you start scaling, you bring more people, you need some further tools, better software to really kind of track how things. And that's kind of where we went in, we searched, and we came across a great software that kind of served that purpose for us. Provided us single entity, provided us all the legal structure to have in place to be able to bring in different deals, evaluate them, and decide how much and who wants to subscribe, and track every investor within these deals in terms of what they subscribe, and allocate returns on a by investor basis on a pro rata share. So that's
So
really kind of the journey that we took when we were evaluating the different platforms we wanted to go.
perfect. So SPV, separate LLC for each individual deal you want to go into. You want to go into 5 different deals. You need 5 different LLCs. Whereas fund to funds model, you create this one entity, all the capital goes in, and you can use this one entity to invest in multiple deals. And it sounds like the investors in the fund get an option to invest into separate deals. They're not bound to invest in all of the deals that the fund invests. They still have some flexibility.
Exactly.
I'm familiar with one piece of software that specializes in this
Mhm.
called Avestor.
Correct.
What software do you all use?
Yeah, that's actually the platform we are on. We are on the Avistar platform, and it's such a flexible software because different people are using it differently. For us, we were looking for specifics that met our requirement, and the fact that the platform is extremely programmable really kind of hit all the key marks for us. The key marks for us was single entity formation, single bank account, login, secure login for every investor separately, where every investor can log in and get to see their own deals, their own uh, cash balance, all the returns on a per deal basis. So deal reporting on a pro rata share, and simplified tax filing. I'll tell you, when you're investing in 1 or 2 syndications, you end up with 2K1s. It's not a problem. But when you start investing in 10 syndications and you have 10K1s, it really starts to get messy. So big part about the platform that we have is we get the K1s at the fund level, and then through the software and our CPA, they end up actually combining the two pieces of data between shares of investment as well as the K1s at the fund level, and issuing a single K1 for every investor. So that's a huge value for a lot of our investors, because now they get their own personalized K1 across all their real estate investments.
Yeah, makes a ton of sense. And this is not an endorsement of Avestor. I imagine there are other software solutions out there that will accomplish similar things. But the idea of this software solution, like Avestor or its competitors, is potentially lower legal fees, where you've got some costs up front, but then you have much lower fees down the road as you add more deals, versus doing individual syndications. You've got legal fees for every additional deal that you do. And so, plus, in addition to all the kind of streamlined paperwork that you just mentioned, using technology and software like this can make a lot of sense for people in your position. BD, let's talk about the deals that you're interested in. So it's tough out there right now. We're in October 2023. Are you investing in deals right now? What gets you interested in a deal right now?
Great. So I'll tell you, since the beginning, a lot of the time that we spend has been really in qualifying and picking the deals, and running all sorts of due diligence on operators. And I'll tell you, we can have a whole session just on that one specific topic. Um, and luckily, I keep my finger crossed. None of our deals have capital calls. We're all in good shape. Couple of deals just slow down the distribution while the market, shakiness kind of go through. But we feel fortunate when I go out and I speak to other LP investors, and I've spoken to several, in the last conference I was at last week, and one investor had like five different capital calls across all his syndications. So it's not the greatest time, but we're still bullish on the deal itself. There's definitely specific aspects about markets, especially when we talk about multifamily. But our criteria has always been the team, the market, and then the product, the deal. That's kind of the order of priority. We really put about 50% emphasis on the team, the sponsor team, who they are, what's their expertise in the specific geography. Are they vertically integrated, especially in the multifamily case? Do they have their own property management? What's their track record? So a whole lot of stuff and focus. Like I said, it's really about the people, their competence. um, uh, Once we get the warm fuzzy feeling from the GP, and we typically over time narrow it down where we only want to work with specific sponsors in a specific asset class in a specific submarket. So when it comes to multifamily, I know there's always a lot of shiny objects, and some is shifting from the southwest, southeast into the Midwest, and we've been very consistent. We're very particular about the markets. For the last 2 years, we've been investing in Huntsville, Alabama, and Dallas, Texas. That has been really the two key areas, mainly because we really like the metrics of that particular market from a multifamily with top sponsors. For multifamily right now, going forward, we are, like I said, very opportunistic. We really look, are they really buying it in distress? So it's really about the buy at this point. If the deal is coming to us and they're buying it back at 2020 prices, or they're getting, 30% discount on what the previous operator. So we've been extremely opportunistic when it comes to multifamily, because we expect that cap rates are likely to soften, and prices would adjust with the new interest rates. And then after we look at the GP, the market, then we look at the deal itself. And probably the most important thing about any deal is really your capital stack and your lending structure, right? That's where majority of the money is. So looking at the loan, looking at the capital stack, looking, where are you in the line, in terms of getting paid and so forth, super important. And then, you dive into the next levels, like, are the assumptions reasonable that the sponsor has taken in their underwriting and so forth. So we tend to be a little bit more picky when it comes to multifamily. We're still bullish on value add storage. The challenge has been with storage is a lot of times we're looking for individual sponsors for storage, and it seems like all the top big guys are just doing fund level stuff. And we're more of the aspect of, we like to pick our own specific deals. We don't want to kind of invest. We don't want to be a fund of fun investing in a blind pool fund. We'd rather have the ability to pick and choose the specific deals. So sometimes we're able to negotiate a carve out. Let's just say they're going to add one more property into their big pool of fund, and they ask us for a carve out, where we come in and we actually drop a larger check and create a syndication on that specific carve out for that specific property. Industrial was still bullish. We're looking at the occupancy in industrial. It's incredible. It's like the last report I read is like under 4% nationally in terms of vacancy. So that's definitely an asset product. But again, we look at it more from a value add. We want to be able to acquire it at a high cap and bring it back into full position, and then dispose it. And believe it or not, commercial retail. I'm still a fan of commercial retail, especially the not the larger commercial retail, but the suburban small plaza. There's definitely significant opportunity there. it's the hairdressers and the nail salons and stuff that we're gonna need. As no matter how people talk that Amazon and everybody ordering their stuff shipping, people still want to go out shopping. They still need to go to their neighborhood commercial retail. So that's not going away. Office for the meantime, we are staying away unless it's a specific deal where it's an office conversion. Likewise with hotels, we've been looking right now at a couple of deals where they're looking at hotel conversion. But like I said, we are very sponsor specific, but we're open to investing in all sorts of asset class. That makes sense.
Yeah, I love that. And with the amount of experience that you have, BD, and you're clearly a thoughtful person. And so you're going to put a lot of time and thought into deals that come across your desk. You've been kind of scaling this fund of funds thing since 2019. I'm curious.
Since 2022.
2022. Okay, so
Is
fairly
when we
recently.
officially founded it and launched it. It was unofficial. It was unofficial
Sure.
in the past, but yes.
Sure. I guess I'm wondering about your the people you invest with. Your tech friends and attorney friends and high net worth friends that invest in your fund with you. Have they been? They don't have as much experience as you do. Have they been sort of jaded or kind of I can't think of the right word, but we've had quite the bull run over the last few years. And so I'm sure you've had some unbelievable deals of 15, 20 or more percent returns annualized. And now we're going through a point where we're just not going to see that, especially with some of these, some of the bigger syndicators. Those kinds of returns are probably just not likely over the next couple years. So are you having to do any education or sort of like reality checks with some of your investors who maybe got used to some of these ridiculous returns over the last few years?
I love your question, Jonathan, because it's almost like you reading my mind here. Before we kicked off the fund officially, we did an active deal where we bought a vacant QSR, and in 6 months we flipped it and made 50%. And the next deal is like investors like, oh my God, give me another one of those. And I keep telling them it's not really as easy and it's not as repeatable to get 50% return in 6 months. So we already had to deal with that even before before the current situation. But um, the big aspect about who we invite to join our group, we want to make sure they have a certain level of competence and understanding in commercial real estate. And we've been creating a lot of educational material for that specific purpose. I mean, yes, I can always do one-on-one classes, and as you know, I love teaching, but I want to spend my time teaching the youth, and that's where I spend about 25% of my time. But again, we have quite a bit of education material and videos for a lot of investors that are joining in. I don't necessarily look for them to be as sophisticated as myself, but we constantly have to provide an update. So, for example, we're providing 2 updates a month, and within those updates, specific updates on every asset investment in the portfolio. And then once a year, we go back and we make an individual video about every deal. Here is the deal. Here is what we're expecting. Here's where it is. Here's the headwind. Here's what we're seeing in the market. And I thought like doing these shorter videos, we're using Loom on a per deal, and we're using Loom, great tool actually. I think they recently got acquired. It just made it a lot easier for me to be able to kind of communicate from a broadcast standpoint to a lot of the investors. Uh, but again, we do have that tight relationship, and I would say a lot of them do watch a lot because I can see how many people are watching these specific videos, are actually watching, are interested. But when they look how poorly the stock market has been performing, and they see continuous stream, continuous update, over communication from our side twice a month on the assets, uh, you know, um, I think they're already kind of programmed to to um, uh, to set their expectation a little bit more correctly. But one thing I'll tell you on what we're seeing, because money is tighter, and I know the number of good deals is a lot tighter, but because money from an investor standpoint and the confidence from the investor standpoint is lower, a lot of syndicators are giving a lot more incentive right now that we've ever seen. So back in 2021, 2022, the incentives they were giving on larger check sizes was definitely not as good as what it is right now. So I think a lot of our investors are looking the value that we're able to kind of negotiate at this point, where by us signing larger checks and subscribing through a larger portion into the deal, they're already seeing the value that, hey, they're going to get a higher preferred return, they're going to get a higher waterfall. And in some cases, even the deal level IRR at a 50K subscription might be lower when you look at what we're going to be able to get on a pro forma or a projected return with the better splits and the better waterfall. It actually goes back to what we used to get in the past. So in some sense, yes, there's a lot of adjustment, but I would say at the same time, money is a lot tighter and puts us in a much better position now to negotiate better on behalf of our investor as we're
At
looking to allocate capital into deals.
At what point could an investor or fund of funds expect to see preferable terms or returns? How big of a check does somebody have to write to an operator to
Sure.
really get their attention to get some preferable terms?
Yeah, I would say, the threshold starts at 250K, and then it goes higher from there. Right now, the way it's really been a game changer for us is through the many different fund managers within the Avister family. So there's about 100 or so fund managers. We are doing a group negotiation across all the funds. So even though each fund subscribed differently to the deal, the fact that we can all come in and negotiate. So if we get to a 2 million threshold, we get this type of return. If we get to a 3 million threshold, we get even a better preferred return. That's really has been a bit of a game changer for us. Is we are negotiating across all the funds. So that's been almost a huge game changer for us, because as an individual fund, you might come in at 500K or maybe a 750 or a million, but it's not significant for you to really demand a much, much better return. But when you start looking about 4 or 5 funds of the same size, they're coming in and subscribing, it's almost, you're getting to the point where almost like you're a family office, level of investment. And it's really changing the game for all the fund managers.
And I imagine it also depends on the deal and how much is being raised, and maybe, what percentage of the raise. If you're bringing 10% of the raise versus 50% of the raise, that might make a difference with the sponsor too. BD, I want to ask you about working with high net worth investors and attracting capital and raising capital from friends, family, and other people that you come into contact with. What suggestions do you have for raising capital and for working with these high net worth people?
Great. So I just want to probably adjust the question so it's a little bit more relevant. So I don't necessarily feel I do raise capital for a specific deal, because my loyalty is not with the sponsor. We are a fund of fund, and I'm an investor in this fund, just like everybody else in this fund, all the LP investors. I am looking after their best interest by making sure these are good deals, and I'm the biggest investor in my own fund. So in some sense, it's lesser about capital raising, but we are, we think about us, we're an evergreen type fund, and it's really about attracting and onboarding like-minded investors. So for us, our avatar is, a successful professional, whether it's in tech or it's in legal, where they might have the capital, but not, or the 401k, but they might not necessarily have the time or the expertise. And what we come in as a solution provider. We're there to provide a solution, and the solution for them is, hey, we go out, we seek the best deals, we filter the best deals, and when we find one we're ready to put our own capital in, we're opening it up, and then we're negotiating on your behalf and our behalf into those particular deals. So I don't necessarily see it more as a capital raising. It's really about attracting like-minded individuals that have the passion or the want to invest in real estate, but don't have the means, the time, or the know-how, or that level of sophistication to be able to pick the right deals. So that's really more about, I would say, we're more of an asset allocator than we are really a capital raiser. We're really going and finding specific assets we want to invest in and bring it back to our investment group and saying, hey, this is a good asset and here's why it's a good asset. Here's a summary of that asset. And by doing that, we are actually start to attract like-minded individuals that want to invest but don't want to do it individually, and do it in our group.
So, bearing in mind that you get better terms on individual deals if you bring more capital, you're motivated to attract these like-minded individuals. How are you going about attracting these like-minded individuals and building those relationships and bringing them into the fund?
I would say for me, the key aspect is about transparency, telling them exactly what we're doing, the value of investing in real estate. So definitely significant part comes about education. A lot of people probably have not heard about syndication. They might understand what, flipping of a property is. A lot of them have some misjudgment in terms of what type of returns you can get in real estate. So I would say definitely education. And I would say understanding with their why, understanding why they want to invest. So I would say you have to really build a personal relationship. You have to be genuine. You have to really understand this other person that you're speaking with, whether they're going to become an investor in your group. What is really their motivation, and you have aligned expectation. Have we rejected people from the group in the past? Absolutely. We didn't feel that they would fit. We didn't feel like that they had the sufficient capital. It felt like this is the last 50K that they have, and so we told them thank you, but you don't probably do not qualify for that level, in a nicer way. And we're happy to point you in a direction of a deal that we want to invest, but to really be part of this fund or be part of this group, it does require, for example, to be accredited. We are looking for people not only going to come in and invest in one deal, invest in multiple deals, and so forth. So I would say, in order to attract these type of people, you have to understand their why and you have to solve the problem for them.
Do you have a minimum amount that you would want new investors to place into the fund?
Yeah, so it's I would say when we have amount in the PPM when they go to actually sign the PPM that they commit to minimum investment. But typically, I would say our average investors is going to at least invest about 5 deals, in each deal, let's say 50K, so 250K. They don't have to bring the 250K right away. They can pretty much upload it every time there's a deal, and they get to pick which deals they want to be part of. But we usually set the expectation. That's really the level amount of investing. So if somebody wants to come in for 50K, probably not a good fit for us. Part of the reason is when we did the structuring, according to the SEC laws, we were limited of having 99 investors. So in some sense, we're 20% of the way there already, within 1 year. And again, big part about our investors, I would say, majority of the early on investors have invested in 6 or 7 or 8 deals so far. I've invested in every deal. I've invested in every deal myself. So again, the thought process there will probably hit the structuring that we have is 25 million. We can expand it to 100 million, but we cannot expand more than 99 seats. So that's a big part of the thought process is they have to be a little bit more serious about, wanting to come in and place, sufficient capital. Because the value is not about you coming in and investing in one deal. The value we get is really about building a portfolio of great investments. And that's really what the platform is here for, is for you to have an equivalent of your E-Trade account. You're not going to open an E-Trade account and buy one stock. So that's why we think the way the investors really make the best potential out of this fund and out of these deals is by participating in multiple deals.
BD, from an operator's perspective, this kind of setup could sound nice for an operator going to one person and getting a larger check for a bigger chunk of the raise. What types of operators are a good fit for raising capital from a fund of funds like yourself? And what types of operators are not a good fit for raising capital from you?
Yeah. So again, when we subscribe in a specific deal, we are subscribing in the LP stack. The fund is subscribing in the LP stack, so it still doesn't fit in the same realm as a capital raise for an operator. You might want to think about us more as a family office, a miniature family office, or a deep pocketed investor at the fund level.
So let me
But
rephrase the question then. Would an operator expect the term family office? That's what made me think of the question. You used that phrase earlier. The term family office for some operators can bring some baggage. It can bring maybe increase expectations. They're going to want a bigger chunk of the deal. There's going to be more oversight, things like that. If an operator works with you or someone like you, should they expect that? And if an operator does not want that, should they just not work with someone like you?
yeah, I would say no, we definitely don't demand the type of things that a family office would do. And we don't necessarily have them change aspects about takeovers and so forth. We do review all the legal docs and make sure that it fits within the umbrella of what we can accept or what we can tolerate from a legal standpoint to protect our own investors. And if it's not within the square block, then this deal is not for us. That deal or that operator is not for us. But as far as the size of operator, we work with varying sizes. I would say the larger the operator gets, the less attractive the deal flow becomes over time. And it's almost like you're really trying to find those rising star operators that have had 2 or 3 deals. They're super focused, and we're able to kind of subscribe to a couple of those, and they've been great. They're really out there to really prove themselves, in the industry, and they're extremely competent. They already have their team in place. But what we try to avoid is operators that are newly formed, or teams that haven't worked together in the past, or operators that do every deal in a different market. So when we're looking to find an operator, we spend significant amount of time qualifying the operator by asset class, by geography, and we intersect it with the markets that we want to invest in by this particular asset class. But we don't have a specific criteria that, oh, we only invest with operators that are 10,000 doors under management, or 2,000 doors. We actually prefer the smaller ones because we have much more leverage to actually negotiate, as long as they show that they have the level of competence. So when it comes to subscribing in deals just for our fund alone, we definitely don't want to be more than 20% of the equity. We want to be under 20% of the equity, mainly because we don't want to sign on the loan. And we are sitting in the LP stack, when it comes to investing. So we're not coming in and demanding to be, part of the co-GP or none of that. It's simple for us. So we actually built a lot of great relationship with operators, to the point right now they put a property under contract. They still haven't done the full underwriting. They actually send us, hey, here's a sample property that we just put under contract. We still don't have the docs, but is that something that you would consider investing in? And that's the kind of relationship we'd like to build with these particular operators. And we'll tell them yay or nay. We still haven't checked with the rest of our investors. We don't know how many people would subscribe to the deal, but does it fit our investment criteria or not? And we'd like to continue to build more and more of these type of relationships, especially with the small to medium type operators. But as long as those operators are expert in their subclass.
BD, this has been a great conversation. I've really enjoyed hearing your perspective and your business model on the fund of funds model. Is there anything we didn't talk about today that you want to make sure that you mention and leave our audience with?
No, I would say just we haven't touched about the nonprofit for youth education.
Please.
This is something I'm extremely passionate about. And when I got to the point where I could redesign my life, and I threw all the cards in the air, and I said, okay, now I get to pick where I'm going to spend my time. And it was really about my health, my family, the real estate investments, which honestly became into a fund. What my plan was not necessarily to start a fund. My plan was actually to go just do my own investment. Just the fund vehicle was a way to actually scale up a lot faster and help others. But then the last one, which is an area that I've been passionate on, is providing education for youth. I feel, and especially like I've seen it in my kids, they went to school here, and there's just definitely not enough education about financial literacy. I realized it early on since my son was, 9 or 10, and we always talk in the car about real estate and building and how to evaluate and cap rates. And he's 16-year-old now, and he went to like a mastermind in multifamily underwriting. Not that I pushed him; he just thought it was be really cool to learn. So again, something I'm very passionate about is we should really educate the youth more about finance, more about money, and not just how important money is, but how to actually deal with money, how to deal with lending. Because frankly, I had to teach myself a lot of that stuff. As a first generation immigrant coming in, going to college, going into corporate career, even doing an MBA, there was just very little financial literacy that was really taught for us. So that's something where I'm passionate on, and I definitely say for everybody there that have kids, please involve your kids more into your financials. Please have these type of discussion at the dinner table. Definitely widen their horizon. People really have to understand. I think one of the best experiences that I've had when I was 14 years old, I worked at my dad's factory. And I thought I'm going to be, there with the secretaries typing. It was back in the day when you had the typewriter. But what I ended doing is sweeping floors of a factory for 8-hour days, 5 days a week. And what that really taught me is just the value of money, like how hard you have to work in order, how little you actually have to earn. So, for a lot of the parents out there, especially in the Bay Area, I'll tell you, they don't really get to have that to their kids. So I would say definitely get your kids more involved, get them more exposed to more things about financial literacy.
And BD, if listeners want to connect with you and learn more about you and the deals that you're doing, where would you like to send people?
Sure. Our website is bfi-fund.com. That's Bluestone Flagship Investors, bfi-fund.com. They can contact us on the website, info@bfifund.com, and we're happy to connect with them, understand if this is definitely a good fit. Thank you, Jonathan. I'm quite appreciate your time. I know we connected and we chatted about several different deals. And that's really something I'm intentional on. Is I'm really trying to grow my network in real estate. I still being looked at as a tech guy, because I worked in tech for 24 years. But what I've been doing since 2019, being a lot more intentional about networking with more and more real estate people, and I really enjoy, meeting people like you and meeting people in this domain, because there's just a lot we can talk about.
Well, the feeling's mutual. Really enjoyed meeting you and having this conversation. Thank you so much for joining me, BD.
Thank you.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to connect with you. Thank you so much for listening. Until next time, take care.